Good morning, everyone! Just hours ago, a bombshell announcement rocked the global economic landscape, directly impacting American industries, consumers, and even our national security. President Donald Trump declared on his platform, Truth Social, that a trade deal with China is done. This statement, coming after 2 days of intense high-level negotiations in London, signals a potential shift in the tumultuous trade relationship between the world's two largest economies. Yet, beneath the president's assertive proclamation, a more nuanced reality emerges, characterized by cautious optimism from officials and persistent questions from the business community. At the heart of this newly announced agreement are two critical concessions. First, China has reportedly agreed to supply American companies with much-needed magnets and rare earth metals. Second, in a significant reversal of recent threats, the United States will apparently cease efforts to revoke visas for Chinese students, allowing them continued access to our colleges and universities. While President Trump hailed the relationship as excellent and a great win for both countries, officials are describing the outcome more as a framework for future implementation, pending final approval from both President Trump and Chinese President Xi Jinping. The agreement on rare earth minerals is particularly significant for the United States. These elements are indispensable for manufacturing a vast array of modern products, from everyday smartphones and electric vehicles to highly advanced defense technologies. They are crucial components in F-35 fighter jets, Virginia and Columbia-class nuclear-powered submarines, Tomahawk missiles, radar systems, unmanned aerial vehicles, and smart bombs. China holds a near monopoly on the global production and processing of these vital minerals, controlling roughly 60% of the world's rare earth minerals and nearly 90% of their processing. The issue became acute after China imposed export restrictions on 7 rare earth elements in April, a move that severely worried top military suppliers like Lockheed Martin, which relies entirely on China for samarium, a key rare earth metal for military-grade magnets. While the agreement eases these immediate concerns, reports from the Wall Street Journal suggest that China may grant only temporary 6-month licenses for these exports, maintaining a degree of leverage over the U.S. supply chain. This means the potential for future friction over these critical resources remains. On the educational front, the decision to allow Chinese students to continue attending U.S. universities marks a notable shift in U.S. policy. Beijing had recently criticized controls the U.S. had put in place to limit access to semiconductors and other technologies, as well as the Trump administration's plans to restrict visas for Chinese students. Commerce Secretary Howard Lutnick had previously stated that the U.S. had retaliated against China's slow rolling of rare earth exports by cracking down on visas for Chinese students. This reversal, allowing Chinese students to continue their studies, addresses a matter that had left thousands of students and the universities they attend in a state of uncertainty. Regarding tariffs, President Trump stated that the United States would impose a total of 55% tariffs on Chinese imports, while China would maintain 10% tariffs on U.S. imports. It is crucial to understand that this 55% figure does not represent a new increase from the recent 30% tariff. Instead, it is a comprehensive accounting of existing duties, a 10% baseline reciprocal tariff, a 20% levy related to the fentanyl crisis, and approximately 25% from pre-existing tariffs designed to counter unfair trade practices by China, some dating back to Trump's first term. This clarification is important, as the immediate announcement might have otherwise caused further market confusion, given the significant fluctuations in tariffs recently. Just prior to this framework, tariffs had been dramatically reduced from earlier highs of 145% on Chinese goods by the U.S. and 125% on U.S. goods by China, following a temporary truce agreed upon in Geneva in May. That initial truce was intended to provide a 90-day window, set to expire around August 10th, for the two sides to negotiate a more comprehensive deal. The London negotiations themselves were spurred partly by the U.S. concern that China was moving too slowly to release exports of rare earths and magnets, which are essential for American manufacturing. This follow-up meeting in London was aimed to cleaning up the Geneva Agreement and putting meat on the bones of that earlier consensus, which had faltered over China's curbs on critical mineral exports. China's Vice Commerce Minister, Li Chenggang, confirmed that a framework was reached in principle for implementing the consensus between the two heads of state from their phone call on June 5th and the prior Geneva meeting. However, the economic implications for American businesses and consumers remain a significant concern. While the deal aims to stabilize the relationship, many industry executives and advocacy groups argued that the damage from previous tariffs has already been done and will not be easily reversed. Retailers, including major players like Walmart, have indicated they will need to raise prices as the 55% tariff, even if not a new increase, is still substantial and difficult to absorb given narrow retail margins. Small businesses in particular face what one advocacy group described as a death sentence, struggling with hiring freezes and paused development due to these high tariffs. Many companies are adopting a wait-and-see approach, delaying orders due to continued uncertainty about tariff policies. The impact on supply chains has also been profound and enduring. Logistics firms and retailers lament that the current 55% tariff on Chinese goods jeopardizes hundreds, if not thousands, of American companies and associated jobs. Freight volumes between the U.S. and China have seen significant year-over-year declines, with China's container volumes down 11%. Problems with empty container returns and congestion continue to plague major U.S. ports like Los Angeles and Long Beach. Experts from the trucking industry have warned that the sector will struggle to recover this year, emphasizing that the supply chain's recovery is contingent on these trade deals being finalized and stable. The fluctuating nature of trade policy, where agreements can seemingly be undone by a social media post, fosters an environment of uncertainty that makes long-term business planning incredibly difficult. Ultimately, many analysts view this deal with a healthy dose of skepticism, characterizing it as having very limited scope and unfinished status. Some call it a fragile truce, or even suggest it's ending with a whimper, not a bang, asserting that the U.S. had to concede on restrictions that were supposed to generate leverage. The prevailing sentiment is that this framework is merely a handshake deal that can change at any time, and that it mostly serves to postpone facing deeper disagreements. While it avoids an immediate catastrophic trade war escalation, it does not suggest that a broader U.S.-China trade deal or geopolitical rapprochement is imminent. Instead, it appears to be a starting point for further negotiations, with the focus likely shifting from tariffs to more intricate export controls, particularly concerning advanced technology like semiconductors. In closing, the recent trade discussions in London have resulted in a framework agreement between the United States and China aiming to ease tensions and address critical issues like rare earth mineral supply and Chinese student visas. While President Trump has declared a deal done, its precise details and long-term stability remain subject to further approvals and the ongoing complexities of global trade. The journey to a fully resolved trade relationship is clearly far from over, and its future course will undoubtedly continue to shape the American economy for years to come. Thank you for watching.